Hello, everyone. Welcome to this panel. We are going to discuss today the very dramatic failure of Silicon Valley Bank last month. This is a bank that few of us had heard of outside of Silicon Valley. But when it failed, it surprised everyone in the top echelons of government, finance, and the economy. What it also did was trigger a chain of events that revealed broader risks in the banking sector and the economy that we kind of didn't know existed. Let me start with introductions of this panel. I'll start with myself. My name is Pallavi Gogoi. I'm the managing editor at NPR, National Public Radio. I am also currently a visiting lecturer in the Humanities Council and Ferris Professor of Journalism at Princeton University. I will be your moderator today. We are lucky to have this very distinguished team of panelists who have both the experience and the smarts to not just share insights and from their particular vantage point, and also provide ideas on how we can reduce some of these risks. Carolyn Wilkins is an external member of the Financial Policy Committee at the Bank of England. Before that, she was a senior deputy governor at the Bank of Canada. Wilkins is currently a visiting research scholar at the Griswold Center for Economic Policy Studies at Princeton University. Atif Mian is director of the Julius Rabinowitz Center for Public Policy and Finance at Princeton School of Public and International Affairs. His book, House of Debt, was widely acclaimed, and it describes how debt precipitated the Great Recession, why debt continues to threaten the global economy. Clearly an important topic right now. Atif Mian is John H. Laporte, Jr., class of 1967, professor of economics, public policy, and finance right here at Princeton University. A few housekeeping notes. The event is being recorded and live streamed. This event is sponsored by the Julius Rabinowitz Center for Public Policy and Finance and the Griswold Center for Economic Policy Studies. We will begin with a quick introduction of the events of the past month from me, and also the individual remarks from both Carolyn Wilkins and Atif Mian, followed by a moderated discussion, conversation, and audience Q&A. We do have a hard stop at 1:20. Most of you know that. We have a lot of you will be going to class at 1:30. So I want to kick it off with a very quick run-through of what happened and why we are discussing this event now. On March 9th, customers of Silicon Valley Bank tried to pull $42 billion from the bank in a single day. It was the fastest bank run in history. Silicon Valley Bank had to scramble to tap backup funding sources at the Federal Reserve. But its own liquid assets weren't enough to tap this source. So within 24 hours, on March 10th, Silicon Valley Bank failed in what some regulators are calling the fastest bank failure ever. It was the second biggest bank failure in US history. This collapse sent shockwaves through the banking world. Mostly because just until a few weeks ago, Silicon Valley Bank was judged too small to cause any real damage if it hit problems. But the moment it got into trouble, everyone realized it was systemic after all. Silicon Valley Bank also received one of the fastest bailouts by the US government on record. By the way, I don't usually go into superlatives like this, the fastest, greatest, and whatnot, but it is that kind of a moment. But what happened after that failure was also quite alarming. 2 days after Silicon Valley Bank's collapse, on March 12th, Signature Bank, another regional bank, also failed. 4 days after that, on March 16th, another regional bank, First Republic, required a $30 billion cash infusion from some of the largest banks in the country. And 3 days after that, on March 19th, in Europe, a large global Swiss bank, Credit Suisse, also failed. It was sold in a very hastily brokered deal to one of its biggest rivals in Europe. All of these events happened in the span of just 10 days. And there are so many questions that arise from these events. We will focus on the response from regulators and government, the weak links in the global financial system, and whether the world is adequately prepared to handle them. The topic, as you all know, is extremely timely. Just a few hours ago, the IMF released a report saying that the tighter bank lending that has been prompted by these failures will actually slow economic growth for all of the United States this year. It just revised down its forecast for US economic expansion. I'll turn it over now to my co-panelists. Carolyn Wilkins will talk about these events from a central banker's perspective with an international eye. Then we will go to Atif Mian, who keeps a close eye on debt and the problems associated with an economy that is fueled by debt and leverage. Carolyn?
Thank you very much for those great introductory remarks and the introduction to myself and my fellow panelists. It's the timeline is truly astounding. In real time, as a central banker, but also as somebody who happens to be teaching a course on financial crisis right now, it was certainly something to watch. And so, you can see from the timeline that's up there just how quickly things happen. But I'd like to take us back before all this happened and think about what part of this was actually kind of something we could have seen in advance. And I think the warning signs were there ahead of time, and people were talking about them. The Fed couldn't have been any clearer that it was raising interest rates when it started raising interest rates. And as it continued to raise interest rates, it was equally clear. And at the same time, you could tell, if you were running a bank, what kind of interest rate risk you were running on your banking book. And you could also tell what kind of deposits you had and how risky those might be in terms of the possibility of them fleeing. Investors, for their part, could have looked at bank balance sheets and kind of gleaned a little bit more than they did in real time in terms of the risks that they were facing. And so, to some extent, it was a missed opportunity to make the right adjustments ahead of time. But nonetheless, the very first sign that we saw that risks were actually crystallizing came actually not with Silicon Valley Bank. It came with Silvergate Bank, who a couple of days earlier had announced a voluntary liquidation. They did that because a high percentage, about 90% of their deposits, were crypto-related. And remember last fall, we had FTX failing, lots of withdrawals of deposits at that time, and continuing in a way that they felt that combined with the fact that the assets that they had there to liquidate to meet those withdrawal obligations had such a large mark-to-market loss that they really thought they should go into liquidation. Of course, days later, we saw SVB Bank in a very similar position for very similar reasons, and unable to raise the capital that their CEO said they needed to raise just based on sales that they had already made to meet those outflows. $42 billion is in one day is just amazing. The UK sub, of SVB Bank had 25% of their assets flow out in one day. So that bank was purchased by HSBC. And the pressure on banks just continued. And I think that really explains why on the 12th, which was a Sunday, very strange, I shouldn't say strange, but an odd day for the Fed and the Treasury and the FDIC to make an announcement, decided that this was a real risk to the system in the U.S. at large, in the sense that once fear gets instilled, that they could be seeing further pressures on bank equity prices, particularly the mid-sized banks who might have been in the same position, but also deposit outflows. And so they announced a couple of things. The U.S. Treasury and the FDIC said, well, don't worry, depositors who aren't insured of SVB Bank and Signature Bank, you're gonna be made whole, and not only made whole, but the next day, Monday morning. And the Fed said, well, other financial institutions that may need liquidity can get it from us through the discount window or through a new facility called the bond purchase program that would value the collateral against that lending at par, which means, given that there would have been huge mark-to-market losses if they had to try to do that in the private market, those were pretty favorable conditions. And then after that, yes, there was still pressure. We saw that with a couple of banks, particularly First Republic Bank, that needed that deposit injection from private banks. But the most spectacular event was the failure of a globally systemically important financial institution. And you just can't really overstate the importance of that going well for the rest of the financial system. And of course, it did because of the purchase from a UBS. There were some ripples still coming after that, in particular because of the way that was financed. Some of the debt holders thought they were in a different place in the loss queue. We can talk about that later, and that may cause some continuing issues. So if I had to just sort of summarize, I would say there's a bit of a déjà vu going on. It's certainly not a GFC situation, but there's some factors if you look there. I don't need to go through them in their entirety, but the unstable funding, the undercapitalized risks that were out there look pretty darn familiar. Now, the risk that was undercapitalized wasn't on the credit side, it was on the interest rate risk side. But certainly, it amounts to the same thing when you need to make good on your obligations on the liability side, so to redeem on deposits. There were serious governance flaws. If you think about what were the boards of directors of these financial institutions thinking? Well, they were thinking that interest rates wouldn't rise as much as they did when they got into that situation, and that this sort of longer-term investment in treasuries and MBS would pay off. They didn't want to hedge it because that would have reduced the payoff, obviously. But at the same time, the Fed did telegraph a change in direction on interest rates, and that didn't result in a change in strategy that was fast enough in terms of those banks' risk management. There were also regulatory failures that we can talk about. At one point, we had Dodd-Frank that tried to get rid of this too big to fail. Some of that was rolled back for these particular banks. A few years later, the Fed also did what they called a tailoring rule, which said we're going to tailor these regulations to institutions to meet sort of a proportionate risk test so that these institutions aren't too burdened by regulations. But what that meant was that they weren't following the same liquidity regulations. They didn't have to flow unrealized losses through in their assets through capital, among a number of other things. And then, of course, we have the supervisor. And the supervisor clearly had a window into the types of risks that SVB and the other banks were running. They did have their regulatory or their supervisory actions in terms of telling them, well, there's these measures that require attention. There's even measures that require immediate attention. But if you looked at the testimony that was at the Senate Banking Committee by Vice Chair Barr, it was clear that perhaps this whole process is a little bit too slow. And so that it's going to be very interesting to see where their own study or their own inquiry of what happened there, how that comes out. And we'll see that on May the 1st. So there's a lot to learn there. I guess the big question that I'll end on is, was this really a 2008 style bailout? Are we kind of back to where we were, even though we thought we'd fix things? And I would say there's a few reasons to think it's not exactly the same, aside from this isn't a big credit event, at least not yet. The statement that no losses will be borne by taxpayers that President Biden said, is really based on the fact that the FDIC, if they bear losses from this, they're going to be paid not by the taxpayer directly. They will be paid directly through special assessments of financial institutions. The equity holders, the bond holders of these failed institutions were not bailed out, and the authorities are looking at the executives of SVB Bank to see, well, what happened when they sold equities kind of prior to the failure. So that looks very different from 2008. There's a nevertheless there, and it comes from a number of places. One is that if you ex post kind of insure uninsured deposits, well, you're running moral hazard, and in some sense, you're subsidizing that. Same thing for the Fed facility that has very favorable conditions. And the FIs that kind of benefit from that facility, and I'm not criticizing the facility at all, to be clear. It's just you have to recognize that those favorable conditions are benefiting financial institutions that may actually have insufficient capital or liquidity otherwise. And that's really kind of looks a lot like, or at least there's a whiff of a too big to fail subsidy there. Some other issues, I'm going to stop now, but that I think are really interesting are the spillovers to the crypto space, and the fact that these facilities and the deposit insurance being extended or effectively extended to uninsured depositors had a benefit and some implications for that piece of the world that I think we'll have to continue to watch. So with that, I'll pass it over to my colleague.
Thank you all for coming. Pallavi, thank you for that introduction. You said my name perfectly. I'm so not used to that. It was a very pleasant surprise. Thank you. I'm going to take somewhat of a macro view to the Silicon Valley Bank failure and talk about why I feel we live in very different times now than we have ever lived before. And I'll try to make that clear in a minute. But I'm going to start off with showing you the yield curve not that long ago. This is beginning of 2022. Yield curve represents market's expectation of interest rates. At the very short end, you can see the market is expecting pretty much zero rates, which we have had for a long time post 2008 recession. But even at the longer end of the yield curve, even 20 years out, the market is barely expecting interest rates of like 2 percentage points. And this is all in nominal terms. So if you subtract target inflation of around 2 percentage points, is essentially zero real rates, negative short-term and zero rates forever and ever, right? And these have been very persistent market expectations. As I said, not that long ago, beginning of 2022, we then have, post-COVID inflation, right? And monetary policy tightens. This is the response of the yield curve to all of the Fed tightening that was done for about a year. And I'm ending this just beginning of March of last month, right? Just before Silicon Valley Bank happened. And you can see the yield curve had shifted up quite dramatically at the short end by 4.5 percentage points. But also at the longer end, it shifts up by about 2 percentage points. Now, it feels a lot in comparison to the red line, but by historical standards, it's not really that much. 4 percentage points long-term rates, it's really still below average in the long run. In fact, it's also not, given the inflation that the US has seen, if you go by the rule of the standard Taylor rule, the blue line did not really jump as much as it should have, dictated by the Taylor rule. People had been complaining the Fed was behind the curve, too little, too late, all of that stuff. Yet, we see something starts to happen in March, and that's what I'm going to focus on. That's kind of the main point I want to make, and then I'm done. The main point I want to make is exactly as I said in the beginning, we are living in times which are not usual in the modern context, and I'll explain why. The main reason is that the economy as it stands today is incredibly sensitive to interest rates rising in a way that it has never been before. And this is the key risk. Silicon Valley Bank partly just happened to be one of the worst banks around, right, in terms of its due diligence and the things that Carolyn talked about. But the events that triggered it was really this yield curve shifting from green to blue. And the other thing that happens is that then we have Silicon Valley and Credit Suisse and all that stuff. So today we sit at the dark blue line as of yesterday, which you can see that, markets kind of got scared and they pulled the yield curve back down again. This is what I mean by it's difficult now for the economy to bear an extra percentage points of interest rate. That burden of interest rate is much higher now than it has ever been. And I want to explain why that is the case, because it has very important implications. As you can see from the beginning, right away, whatever that weight of interest rates is, it's pulling pressure on monetary policy in a way that is making it very difficult for them to raise rates. And that may have very important implications given the set of cards nature might throw at us going forward. So in particular, if inflation for whatever reason, and we never truly understand inflation, let's be honest. So if inflation for whatever reason stays at a higher level, we might have difficulties because there might be a trade-off. But there may not be. Now, we can talk about that in the discussion. But what is for sure is the case is that the economy, the macro economy, the global economy, including the US, is in a place where the burden of high interest rates is much larger than it has ever been. And now let me just explain what I mean by that with just a couple of simple plots. In order to understand why interest rates are so much more burdensome, the rise in interest rates in particular, you need to understand just two plots in my view. First is this incredible rise in debt. I'm so fascinated by this picture that that's basically my day and night. That's what I do, just looking at this graph. And why, what's behind it, what's the implications of it, but if you look at overall debt, this is household debt, government debt, corporate debt, the total sum of debt. I'm showing you the United States, but it's a global picture, really. It's happening everywhere. There's been this incredible rise in debt from the 80s onwards, almost doubling of debt per dollar of output that the economy produces. And then 2008 was sort of driven by debt, but we kept creating more debt. So we need to understand why the economy is addicted to debt. We don't have time today possibly to talk about it, but I would love to talk about it because that's what, as I said, that's what I do for a living these days. So, but this is very important to keep in mind, this incredible rise in debt. The other picture that is very important is the fall in interest rates all the way down to zero, the initial sort of this red line in the yield curve that I was showing you in the very beginning. And these two things are actually very closely related. It is not possible to have this incredible rise in debt without a fall in interest rates, because that high level of debt would not be sustainable. So we really have to understand why these two things are co-moving together. And the reason actually part of the reason has to do with rise in extreme inequality. Okay, but I'll just leave it out there, but that's sort of what's happening in the background. What I want to focus on is, again, because it's about Silicon Valley Bank, is the consequence of this. And one very natural consequence of very high debt and very low interest rates is you can do some simple bond math. And here I'm showing you simple bond math two different ways. One is for an infinite bond, which is like perpetuity, or if you keep rolling over debt, that becomes a perpetual bond. Or you can also think of it as impact of interest rates on land, which is a perpetual asset. Either way you think of it, the point I want to illustrate here is this is what happens to the value of a 5-year bond and a perpetuity, which you can think of as the land, or if you keep rolling over debt, that's effectively the same thing. You can see what happens to a 1 percentage point permanent rise in interest rate, like a shift in yield curve, not of 2 percentage points, but just 1 percentage point at different levels of interest rate. And what you can see is that when you are at low interest rates like we are today, the valuation impact of the same percentage point rise in interest rate is much larger, is much bigger. And this is the pressure that balance sheets of banks and anyone else who's holding these long duration assets they're going to be subject to it. And it's going to be, this force is going to impact banks, but it's also going to impact households. And in fact, it's also going to impact governments. And so all of that means that because of this very low interest rates and very high level of leverage or debt in the system, the same 1 percentage point interest rate rise today has much stronger implications. And this is something in the past, we have referred to as indebted demand, which is to say that when you have this high level of debt, it makes it very difficult to raise rates, which is why you have this continuous pressure on rates staying low. But that, and I'll close on this, that leaves kind of this open question, which I think is a big question mark. One possibility is that because of this downward pressure on the economy of even small rises in interest rate, we naturally balance ourselves. We're worried about inflationary forces, but you raise interest rates a little bit and there is a big damping down on demand because everybody, credit gets tightened, as Pallavi and Carolyn also mentioned. Everybody gets worried about the banking system. That naturally acts like a negative shock for aggregate demand, and that's exactly what you wanted. So you're good. You're good to go. But imagine that there is another force from the outside that inflation does not. Maybe there's a change in expectations. Maybe people add a risk premium that they weren't adding before. The point I want to leave with is that the system remains extremely fragile precisely because of these very large valuation effects at low interest rates. So if for some reason risk premium rise or inflation does not fall as quickly as we might hope, and the system kind of requires higher rates for longer, the overall financial system and the overall macroeconomy remains very fragile to those kind of tensions and risks. So I'll close on that and look forward to the conversation. Thanks again.
Thank you, Atif. Yeah. So Atif, I'm super interested in your statement about the economy right now being enormously sensitive to interest rates, but I do want to start with the central bank question for Carolyn. You mentioned, a little bit in your introductory remarks about how, there has been a rolling back of oversight of banks. In 2018, Congress did scale back oversight, the additional oversight for banks that were slightly smaller in size. So what happened was that the threshold of scrutiny went up from $50 billion in assets to $250 billion. Among the smaller banks that did testify before Congress, asking for less supervision, was the CEO of Silicon Valley Bank. He said at that time that his bank was kind of boring and wasn't really risky to the financial system. But Silicon Valley Bank did grow very fast. It nearly tripled its deposits in just 3 years. And it put a lot of its spare cash, as Atif mentioned, in long-term, mainly government-backed bonds. Its assets did grow large enough for the Fed to warrant a new level of oversight by the Fed in late 2021. But so the Fed did have access to a lot of data and information from the banks, including Silicon Valley Bank. And we know now that federal regulators did warn Silicon Valley Bank repeatedly about its risk management practices. It sent warning letters. These letters are usually sent before they precede actual action. However, the Fed did not act on that information. And there's a lot of questions, Carolyn, on whether central banks like the Fed are equipped to handle this kind of oversight. In a recent congressional hearing, very, very recent, we've had senators from both sides of the aisle. In the banking committee, there was Senator Tim Scott who's a top Republican on the Senate Banking Committee, he said, by all accounts, our regulators appear to have been asleep at the wheel. Senator John Tester, who's a Democrat from Montana, said, it looks to me like the regulators knew the problem, but nobody dropped the hammer. So I have two questions for you, Carolyn. One is, should the rules be changed where the country goes back to supervising banks with fewer assets, $50 billion and not $250 billion? Secondly, the Fed did know but didn't act, and that has raised questions about whether the Fed is really good at what it does. Could it have done more? More importantly, should the Fed continue to supervise banks? If not the Fed, then who?
Yeah, those are very pertinent questions. But I guess I should just include all my answers or precede all my answers with that I'm speaking on my own behalf, and what I say doesn't necessarily reflect the views of my Bank of England colleagues. I'd lose my central banking license if I didn't say that. So, especially given the questions. You know, every society, every elected government has to decide how much risk they want to take, given their full set of objectives. And the objective of Dodd-Frank in the first place was kind of a never again thing in terms of the taxpayer being on the hook for failures of private profit-making institutions, in this case, banks. And then at one point after that, it was thought that, well, you know what, this may be actually for smaller banks and smaller than the original threshold, kind of restricting, access to lending and other banking services to, really, households and American businesses that actually could use those in a productive way. And so we're going to right-size it. And so it's, with retrospect, you can see that it would have been better off if they had have had more stringent regulation with respect to capital, more stringent regulation with respect to liquidity coverage, and also stress testing that reflected the kind of risks that people could reasonably think we were facing. And so those are things that clearly President Biden and others have said need to happen in terms of reviewing what part of the rollback do we need to reinstate, and other things that we should be looking at as well. And it's here I would say that having been, this is full disclosure, I was a co-chair of the liquidity working group for the Basel Committee when we developed the LCR and then NSFR, and I can tell you those are the liquidity requirements. They're far from perfect in a couple of dimensions that I won't trouble you with, but clearly there's a case to looking at those too and saying, is there a way, given what we've just learned, to make them even more effective than they were? But I should say that for the financial institutions that are following them, in particular the LCR, they're probably glad they are. And SVB Bank and others weren't. Your second question, I would say the most important thing with respect to effective regulation and effective supervision is to have clear independence, whether it's a central bank or whether it's an independent entity. In Canada, it's an independent entity. At the Bank of England, it's the same. It's the Bank of England. And the reason that's just so important is that often there are objectives that a government might have that imply trade-offs. And so in this case, they wanted smaller banks not to have such a big regulatory burden. Obviously, the trade-off was stability of those financial institutions. And even though a central bank and the supervisors are independent, there's always politics that are going to be involved. And I don't have any insight into the U.S. system. And I'm not saying there's lots of politics in other jurisdictions, but it's kind of naive to say there's none. And so the supervisors need to have a very methodical way of imposing the rules that they can stand up to ex post to the financial institutions that they're overseeing. And so I don't think a simple change of who's doing the regulation really it changes, it change la mat de place. It just changes the problem to another place. The real problem is having the right resources and having the right mandate and being empowered to do your job.
Thank you, Carolyn. Atif, as I mentioned, you've talked about how the economy is so sensitive to interest rates. Just yesterday, the New York Times had an article which started with the story of Sarah Puel, who owns a company called Boxed, which sells upscale wine. The company's been around for 3 years. She needs to borrow between $500,000 and $1 million so that she can buy her premium red, white, and rosés by the end of this year, so that she can create these specialty blends that she sells to her customers around the country. But she suddenly finds that the thing that she was able to do, which is borrow money, is not available anymore. And she's an entrepreneur, so she's talking to other entrepreneurs all the time. Any of you who are entrepreneurs here will know that this is something that entrepreneurs do. What they're finding is that both borrowing money and raising money has become very, very difficult and very expensive very quickly. I'm literally talking in the last 3 weeks. She said it's all we're talking about. And by the way, borrowing of all sorts is becoming harder. Mortgages, auto loans, Atif, all of the stuff that you are watching very closely. So when access to lending or borrowing becomes really difficult and expensive, we know that businesses will find it very hard to expand and grow, especially businesses that need that kind of capital at this particular moment. She's only been in business for 3 years. She needs the money. It usually lays the groundwork for stronger businesses. But when that happens, when access dries up, that basically lays what I see as the groundwork for broader economic slowdown, which is kind of probably what the IMF is seeing. Question for you is, Atif, is how much of an impact do you think this is going to have on the economy? And how, what can be done about it? I mean, what is the way out?
Yeah, so first of all, this is exactly one of the natural side effects of the kind of forces that I was talking about. Silicon Valley Bank brought into salience these kind of facts. You can see other people kind of doing these calculations, and they're saying, okay, this is how many unrealized losses the banks are sitting on because interest rates have risen since they bought those assets, and and that it's just that simple graph is kind of everybody's kind of focusing on that one way or the other, and that is creating tightness in the credit origination business. In fact, if you look at the most recent bank loan surveys that the Fed releases, the tightening is the highest we have seen since 2008. Okay, so it's quite extreme. What I want to highlight a little bit is why are we here? And I think in a sense, collectively we have run the banking system in a way that it's not really supposed to be run. Let me try to explain what I mean by that. We just talked about regulation. We give banks this incredible cushion safety net that we call the Federal Reserve System, lines, liquidity, access, bailouts, implicit and explicit at times, and all of that. And all of that, Diamond Dybvig recently won their Nobel Prize as well, and all of this is justified under the Diamond Dybvig framework. But there's a very important assumption lying behind it all, which is that banks are doing something useful. And if they are doing something useful, then yes, let's give them all of this incredible social safety net that we all provide. But what has gotten lost in the regulation discussion is that for a long time, banks have moved away from doing something useful, which is lending to exactly the kind of story that Pallavi mentioned in New York Times, which is like productive loans. That if you look at what banks have been doing more and more so recently, and by recently I don't mean like yesterday, I mean over the last 20, 30 years, they have systematically moved away lending for productive reasons, which is what we call investment or working capital. And what they are lending is more and more what Silicon Valley Bank was doing, which is holding long-term securities, for example, mortgages, consumer credit, or lending to governments. We do not need such a costly banking system to lend to governments. You and I can lend to governments very easily through our pension funds, for example. We can also hold mortgages if we have to, if we want to. And so I think there is, there needs to be a closer understanding of what is it that the banks do that then gives them this option value of having access to the safety net. And if they don't do that, then, you know, maybe we need to structure them somewhat differently. And people have talked about, in fact, none of this is new actually. You know, going as far back as the Great Depression, very serious economists sat together and they came up with what was called the Chicago Plan famously. And one of the things they advocated was precisely this, that to the extent the banks are just providing payment services and so on, that needs to be backed up with something like 100% reserves. They could hold government securities and very safe, no duration mismatch stuff. And that can back the payment system. And the other, the actual investment and working capital can be dealt with separately. So I think those are some very deep structural issues that we need to go back to understand what is fundamentally a flaw, in my view, in the way the Basel rules have regulated the banking system. And those need to be re-looked at with the focus that, you know, what we want banks to do is lend for productive reasons, and the unproductive lending needs to be dealt with differently.
Thank you, Atif. I have so many questions. I do want to open it up to the audience, but before that, I will ask one more, Pallavi, which is the question of the insurance, right? So the FDIC, or the Federal Deposit Insurance Corporation, this is a government agency, basically guarantees all deposits up to $250,000. The financial institutions that have a lot of deposits that are higher than that amount, basically are exposed to bank runs, which is kind of what happened with those two banks. From the reports that we've seen and from a testimony by FDIC Chair Martin Grunberg, it seems like 90% of Signature Bank's deposits and 88% of Silicon Valley Bank's deposits were higher than that amount. So basically, these are amounts that are uninsured by the FDIC. But when the two banks failed, the regulators, FDIC, decided to basically guarantee all deposits. I think, Carolyn, you called it a moral hazard, even if they were larger than $250,000. Now, the question at hand, and what Congress is going to talk about, I think, discuss, the FDIC itself is considering a policy option of changing the deposit insurance levels, increasing it most likely, among other elements in the system. I want to ask both of you, is that a good idea?
This is very much related to what I was just saying. In fact, the math is very simple if you look at the aggregate consolidated balance sheets of the banking sector. About half the deposits as they were beginning of March were below the 250 limit, and about half were above the 250 limit, right? So we are talking about, like, should we back the remaining half of the banking system or not? And in my view, you don't have to, if you change the structure of the banking system along the lines of what I was saying earlier, because if you look at the asset side of the balance sheet of the banks and say, okay, what is it that they're actually doing with this money? This goes back to this, how much are they lending for productive reasons versus for other reasons? It turns out that about half, at least in my view, is devoted to just holding securities, holding treasuries. Well, if that's what you're doing, which is fine, just separate that piece and back the bigger deposit base, the above 251, with that 100% reserve banking system effectively. Just regulate it very differently. The payment system, I do feel the payment system should never be at risk in a country like the United States. So I am sympathetic to the view that it would have been crazy to essentially let the payment system go to the dogs and say, okay, you know what, all these big corporations, these startups and so on, sorry, you don't have money for payroll. Because, the reality is when people put money in a bank, I don't want to think about it. If I'm using it for payroll and things like that, you need that safety of the payment system. That's a very important role of money and payment system as a public good. And this whole notion that those people need to discipline the bank by running on it is like just crazy. I just don't get it. It's never, and when push comes to shove, the government always reacts like that. Because you need to, what can you do? You can't let payroll fail because some bank failed, no matter what the amount of your deposits is. So again, I think it's fundamentally we have to structure banking and regulation differently. So it is a longer conversation, but not just increasing deposit insurance and saying, okay, now you have an infinite subsidy at some level. I think that's misguided.
I'm just struggling to think what I would add to that, just because it's so right. All it would do is take the risks that exist now and put it on the government. And, you can say, well, it's the surviving banks that pay, but you can be sure that those surviving financial institutions pass on those costs to their customers. So it's just not coming to you through a tax. Aside from the fact that there's the moral hazard that comes with that, because there's no way you're going to get an insurance premium on that's going to really reflect the risk. It's just going to be very hard for that to happen. And I think a society needs to decide who do they want to insure for, or for what purpose. So there's the point about what are those deposits doing in the economy in a way that adds to societal welfare. If they're investing and they're creating businesses, that's kind of one thing. But who decides that? What adds to societal welfare or not? And then the second thing is, do we care if it's a retail deposit, so it's like us in the room, or do we care if it's Circle's reserve fund or a major corporation's wholesale deposit? Do we want to think about social safeguards in the same way from individuals to profit-making corporations? And so in the choice of that, it's not just a blanket, oh, gee, this will get rid of the risk. It's going to put it all on the government in a way that I think governments need to think really hard on, which makes it sound like I think it's not the best way to solve that problem. And a better way is to go along the lines of Atif, particularly on managing the risks in a different way of runs with financial institutions that are taking deposits.
Thank you, Carolyn. And Atif, let's go to questions from the audience here.
So we're going to pass the mics around for questions. And Pallavi, I don't know if you want to collect a few questions at a time.
Yeah, so I completely agree with you, Atif. Actually, that's the Chicago plan. I mean, Henry Simons, Milton Friedman, 80 years ago talked about you have, commercial banks, 100% reserve backed. Yeah,
I just want to add, Michael Bordeaux is one of the most famous historians, so he knows what he's talking about. So.
Right, and or narrow banking. So you're right. But my real question, it's about monetary policy. Okay, so what just happened is 100% to me predictable, because if I look at every Fed tightening cycle that's happened since World War II, okay, what happens is there's almost always a credit event somewhere as things get going, okay? You don't know where it's going to be, but it always happens. Examples, credit crunch of 1966, the Latin American debt crisis in the early 80s where Volcker was involved, 1991, Bernanke wrote about the credit crunch that occurred in New England. Okay, the beginning of this century, and then even going to the GFC. So the mechanism that Atif's talking about always comes about, but it's hard to say where it is. But the real question is, if you know that you're going to have a credit crunch, that's a very significant part of the tightening cycle, shouldn't the Fed have been looking for it? I mean, it seems like the real problem is, and I don't know if you're going to blame anybody, but the San Francisco Fed really dropped the ball. I mean, they saw this, they didn't do anything. But I think it is a problem that it's predictable. It's part of the story of tightening, and it's always going to happen. So you can get at the regulation issue, okay, but you're still going to have credit crunches somewhere in the economy.
Thanks, everyone, for your comments. I kind of have a question related to how does a potential change in FDIC guarantee scheme change the role of the Fed in monitoring financial stability? I think you hinted at kind of the political economy of regulatory reforms as it relates to SVB not being characterized as, lobbying to not be characterized as kind of a systemically important bank. And I think, to me, my concern is I see an FDIC increase in guaranteed rates as an easy fix in a politically constrained environment because it's just a guarantee that doesn't have any upfront cost to the government. So in that context, if something like all deposits being insured is the path that the U.S. takes, how does this change the Fed's assessment of financial stability risk, given that if there are any costs that start to arise, all of them fall then back onto the government and have these different kind of mechanisms that feed through to the economy?
Carolyn, you want to take that?
Sure. Yeah. So I just want to start with Michael Bordeaux's question, which is insightful as it can get. So you're right. If you know you're going to have a credit crunch, then why didn't you see it coming and do something about it ex ante? I think there are two things. One is that it wasn't until later that I think central banks, if you look at their own forecasts, realized that interest rates would need to go as high as they ended up having to go, and that's because of their call on inflation and with the temporary aspect of some of these supply constraints that we were seeing, and so. But that being said, I could just speak about the Bank of England just because of the structure there, where there's a monetary policy committee, but there's a financial policy committee that does the stress testing on the financial institutions. And clearly, a backup in yields, things like that, a snapback risk is what we were calling it at the time, were simulations that we do with financial institutions to see how resilient they were and what they needed to do to become resilient. Even though you would assign at the time, you might have assigned a small probability to that. And you add to that in the UK, all banks of all sizes hold capital against the interest rate risk on their banking book as part of Pillar 2, which has some spillover effects to how helpful that is for other aspects of their safety. And so, there are things that can be done. I can't look into the Fed and see what they were doing, so I won't comment on that. On the FDIC, clearly this is not unrelated in the sense that if the Fed, oversees banks to some extent, they have some control over the risk that will end up back on their own balance sheet. But to the extent that they don't have control, well, they're just going to live with whatever happens to happen in the financial system, whether it's within other financial institutions or with non-bank financial intermediation or shadow banking. I think where the important work needs to be done is not just at the Federal Reserve, but also with the Financial Stability Oversight Committee, which has a role expressly to look at that. And so it's really a combination of how those entities all work together, identify the risks, and to decide who's going to be the one that mitigates them and how, and what's the best way is collectively to do that.
Okay. It was mentioned that banks are doing less productive lending and putting more money into government securities and stuff like that. I guess I just wonder, to what extent is that attributable to the massive increase in government debt that's occurred in the last few years, since there's obviously a lot of government debt available. And the other thing I've heard is that foreign countries are not buying much U.S. government debt. At least they haven't in the last few years. Their holdings of government debt has kind of leveled off. So I guess this is something we used to call the crowding effect, of government borrowing, crowding out private investment. Do you think that's a factor at all in this case?
And it is hard to think of crowding out is that think of what crowding out means. The standard crowding out effect would be government starts to borrow and interest rates rise that crowds out the other party. We don't see that. We have actually seen interest rates continue to fall over that horizon. So something else is happening actually, which is again what I hinted towards is this rising extreme inequality, and this as a result of that, plus other factors, the rise in saving glut, both inside the US and globally. And that saving glut has led to falling aggregate demand. And so to reboost demand, the economy has been requiring credit creation and debt creation, which is what has forced the hand of the governments to run larger deficits. And so that is in play. Now, that's a different, longer conversation, but that's happening in the background. But the thing is, if for whatever, let's say you need to do that for all the reasons that I just talked about it, you don't need this highly levered banking system to fund that government. That's the point. A narrow bank, like the Chicago plan style bank, can fund those deficits very easily. You don't need to risk the entire payment system to fund governments. That's sort of the broader point. And just quickly on some of the earlier questions, Michael, you're absolutely right. In fact, Veronica here has looked into that, and as far as we can tell, the main stress test that the Fed is interested in is the credit risk. And so unemployment rises and interest rates always fall, obviously, in those stress tests. But someone should have done the interest rate risk test, which is much more worrisome in this kind of situation. Patrick, question on all deposit insurance. A big problem we've had, like think of Italy. Does anyone believe in the price of Italian bonds? No, because it's all backed by whatever it takes kind of mantra at the bank of at the European Central Bank. And so when you back more and more of debt and so on, you lose price signals of what is actually happening underneath it all, because government is backing all of that up, and that promotes more and more credit creation and and not thinking about risk as much as you need to. So I do worry about all of that a lot more. That is why I'm saying that's not the way to really solve these issues. We do need to internalize the implicit costs that is implied with these deposit insurance contracts.
I do have a follow-up to that. You talked about the savings glut and the reboosting demand. One of the things that has come up as a criticism of Silicon Valley Bank is that it was very concentrated in a single industry, in tech, and there are a lot of questions over whether the customers of a bank need to be much more diversified. What is your take on that, both of you?
It certainly helps. I think it's in hindsight, Silicon Valley Bank was just a very crazy bank. I mean, if you just look at its balance sheet, I think it had many problems, and they were multiplied by the concentration of the depositors. The thing is with deposit insurance of the right type, you don't need to necessarily worry as much about the diversification of depositors, because what matters is the overall deposit base of the system as a whole, right? And as long as, going back to sort of Michael's question of proper due diligence and so on, so as long as you're running the proper stress tests and regulating the capital requirements and all that of the banking system, which again has historically been too low. So we need to raise that. We need to separate out the narrow part of banking, which can be done separately. I think those issues are more first order rather than sort of the composition of the deposit base at the bank level, in my view.
Do you have a view on it, Carolyn?
I think that's clearly concentration, whether it's on the asset side or on the liability side, is a risk for the bank that needs to be properly managed. So it's really about how are you managing that risk that you're facing. I think there's also an an even bigger question, though, that's related to the one that you asked is, what kind of banking system does the U.S. want? Because it's not just Silicon Valley Bank that's concentrated. All the regional banks are too. The smaller banks, they're just concentrated in different ways. And so, one of the worries that or concerns that have been, rising now is, are we just, moving towards a more concentrated banking system in the U.S.? And so those trade-offs between regional versus national or big banks is one that needs to be faced. And in some sense, it's a question of risk on the one side, but also serving local customers on the other.
Well, we are at time. I want to thank all of you for coming, and to our panelists here, Atif, Mian, and Carolyn Wilkins. Thank you so much.